So please don't share any confidential information, as this is a public forum, and the link to the recording will be made available after the presentation. Okay, well, welcome everyone. Good morning, good afternoon, good evening. My name is Ali Dadvakili. I'm an attorney with K&L Gates. We are an international law firm, full service. And what we're here to talk about today is how to position your startup for venture capital funding. So I'll go over a little bit of the program today, but a little more on the housekeeping. Please consider these to be educational, educational presentation, educational material. We're not establishing any kind of attorney-client relationship. Oftentimes I get questions during these presentations, and although your question may be specific, just please note that I can provide general sort of high-level conceptual ideas. I'm not going to be talking or addressing your specific legal issue. I'm happy to talk with you offline, or you can reach out to me to set up a time to discuss any specific facts or circumstances, but you always want to be careful in getting information without knowing all the facts. So please keep that in mind. And last thing I'll say on this is don't rely on what we say for your particular circumstances. Oftentimes, as they say, the devil's in the details. So without knowing more of your particular facts, it's really hard to answer any specific questions. This is essentially basically saying the same thing. Okay, so let's start with a little bit of an overview of what we're going to be talking about today. I'll talk about my background. We'll talk initially about structural considerations as you're positioning your startup for VC financing. That's going to be an important consideration to take into account. We'll talk about what the documentation looks like for founders and early employees, talk about some of the financing instruments and vehicles that can be used before you do your first venture round. We'll talk about valuation and dilution, pro forma cap tables, overview of financial, venture capital financings, preparing for closing a venture capital financing, and some of the common pitfalls that I see from time to time over the years. And hopefully we'll be able to steer you away from those by talking about them and making you aware of them. And we'll reserve about half an hour at the end for a Q&A, and certainly welcome your questions. It's a little difficult during the presentation to respond to questions. I will look up occasionally and see if there are any questions. But if you can hold your questions to the end, that would be great. If you do have a burning question, I'll try to get to it as I can during the presentation. Okay, so let's talk a little bit about my background. As I said, my name is Ali Dadvakili. I'm an attorney with K&L Gates. I'm in our corporate practice, and I focus primarily on emerging growth and venture capital. So essentially what that is helping companies from very, very early stage, where it's a couple folks in a garage with an idea and not knowing really what to do next, helping them form their company, helping them get organized, raise financing, all the way through growth, scale, and exit. Whether that exit is a sale of the company or an IPO, something along those lines, it's the whole life cycle. I work out of our San Francisco office and have worked with companies throughout the US and the world. A lot of companies that I represent are based in the US. I have also a number of companies that are outside the US that are looking to come into the US and want some guidance and information on how to come and establish a footprint in the US. So we help with a lot of those cross-border type situations as well. I always enjoy working with startups, entrepreneurs, founders. I find the creativity, the innovation fascinating. Some great folks I've worked with over the years, and really enjoy being a small part of a startup on its adventure as it grows and scales and has a successful exit. So very, very rewarding work. So I'm going to launch a poll right now that has a couple of questions. I think there's 3 questions. If you don't mind, take a few minutes or take a few seconds. Let me know where you're from. Let me know a little bit about your background. We'll close the poll in maybe about 15, 20 seconds or so. This is helpful because it gives me a sense of where everyone is in the world, but also if you've been through financing before, whether you're an entrepreneur or founder, et cetera. So I'd like to get a little sense of the audience as we start. Looks like we're getting some folks that are responding. That's great. So I'll give it another maybe 10 seconds or so, and then we'll close the poll. But if you haven't responded yet, just click on a couple of those buttons so we can get some good information. Okay, So looks like we have about 16% in the Bay Area, about 42% elsewhere in the US. We have some folks in Europe, pretty large group from Asia, about 19%, 6% from Africa. And those comprise most of the places that people are from. First-time entrepreneurs, 58%. Wow, that's a large percentage. That's great. So really delighted to be able to present to you, and hopefully some of the information I'll pass on will be valuable to you as you start this adventure. Serial entrepreneurs, we have about 10%. Great. Early stage folks in an early stage company, about 26%, and then growth stage company, 3%, mature company, 3%. So looks like by far and large the majority are first-time entrepreneurs. So that's wonderful. Really appreciate you joining in. Okay, so let's move on and talk about structural considerations. So one of the first topics you want to be thinking about when you're looking to do a financing, we're focusing on how to position your company for VC financing, and that's kind of the focus of the presentation. But even very early on, before you get to that milestone, you're going to have to set up your company. You may do some earlier financings, which I'll talk about, whether it's convertible note or a safe. And before you even get to those early stage financings, you want to be thinking about a couple key issues. One is, what type of entity should you form, and where should you form that entity? And obviously this is all focused on the US. So thinking about, I'll talk with the jurisdiction first. Where should you set it up? By far and large, the most common place we see startups setting up their company is in Delaware. And I'm sure a lot of people on this presentation have heard about Delaware being sort of the preeminent state. It is a wonderful state to use. It's very well known, very well liked by investors, by startups. It's very efficient in getting stuff done with the Secretary of State. They have a really good set of laws on the books for corporations. It's regularly updated and reviewed. They have a very special court called the Chancery Court that if there's ever a business dispute and you end up in the Chancery Court, you can be assured that you're going to end up in front of a judge who has a tremendous amount of experience and background in corporate law, in business law. Whereas in other parts of the US, you may end up, if you have a dispute, unfortunately, you end up in a court, the judge hearing your case may not have a particular background in business. They may be a family law judge. They may be a judge that, had, before they came onto the bench, had a practice that has nothing to do with business. So you don't get the benefit of having someone with a lot of experience. So those are some of the top reasons that oftentimes Delaware is the preeminent state. But I would say the number one issue is really because investors like Delaware. So they really want Delaware Corp. They understand it. Most of their deals are in Delaware Corps. And so you might as well start off and set things up properly by choosing the right jurisdiction that investors typically prefer. The second key issue is, what type of entity should you form? There are a lot of choices, but ultimately when we're talking about a startup that is going to go out and raise financing from investors, from third-party investors, you really have one preferred entity type, and that's the corporation, and it's a C corporation. There are other business types in the US. There's sole proprietorship if you're just an individual with a small little company. There's general partnership, limited partnership, LLC, and then there's the corporation. The corporations have been around for a couple hundred years plus, very well known, very well established. So investors also like that entity type above all others typically. So if you're looking to position your company for VC financing, those two key issues off the top are setting up your entity in Delaware typically, and also usually, almost always from my vantage point, setting up a corporation, a C corporation. There are two types of corporations. I'm not going to go into it in too much detail, but when you first create a corporation, you first form one, it's automatically by default a C corporation. You can you file a special election to create an S corporation, which allows it to be a pass-through. And that has some benefits for tax purposes, but I can tell you investors typically don't like that structure. So for you typically want to just set up a plain C corporation. Down the road, you can always make changes depending on your circumstances, but that's the best way to at least start off. Okay, let's talk about founder and early employee documentation. And I positioned this here at this point because, again, as you're starting your company, as you're starting to position your company for financing, another key issue besides jurisdiction and the type of entity is to make sure you start structuring it in a way and have the documentation set up that is going to be the most efficient and will meet the requirements of your investors, your typical VC investor. So documentation is key. I can't emphasize that enough. I'll mention that throughout. There'll be a recurring theme you'll hear me talk about. Early documentation is key. So if you start building a habit now to ensure you have good documentation in place, you will be so much better served when it comes time to do your first financing. And when the investors are looking at your books and records and they're not having any issues, there's no problems they're raising because you've done everything properly from the get-go. It'll save you an amazing amount of time, stress, a few sleepless nights, and a lot of money as well. So what does that mean, proper documentation? So there's a few things that you should be thinking about. One is whenever you have someone that's going to be starting off, whether it's a founder, co-founder, early employee, consultant, advisor, if they're going to be helping you develop your company, and that could include helping develop the technology, it could include helping develop the marketing, the advertising, whatever is going to be valuable to your company to help it grow and start to get to the next level. You want to make sure you have an agreement in place with those individuals so that they sign over all of their rights to what they're creating for the company to the company. This is a super critical point because I've seen over the years issues where people haven't done that. And I'll give you an example. So someone starts a company, there's two co-founders. One person is the CTO, the technology person, the other person is the finance person. They start the company, they file everything. They forget to sign these invention assignment agreements. And after 4 or 5 months, the CTO gets frustrated. It's not growing fast enough and she leaves. Now, keep in mind, she developed technology. She never assigned it to the company. Now you've got a situation where the founder that's continuing on with the company doesn't have clear title to the technology that the CTO developed. Huge problem. And when it comes time to do a financing, they're going to find that they're not going to be able to tell their investors that they own the technology. And unless they can correct that, oftentimes that can kill a deal. That's one of the quickest ways to kill a deal is the company realizing it doesn't own what it thinks it owns. So there are documents in place. They're put in place early on, founders, employees, advisors, as I mentioned. You basically sign the agreement saying whatever you're doing for the company you're developing is going to be transferred over to the company. Vesting of securities. And so talk a little bit about when you are a founder forming your company, you're going to get shares in the company. This also applies to whenever you give shares or options to employees or advisors or consultants. They're getting some sort of piece of the company, whether it's actual shares or whether it's an option to purchase shares. You also want to make sure that you have in place a way to motivate them and incentivize them to stay with the company over the long term. So, example, you have a founder, two founders. I'll use the same example, the CTO and the finance founder, right? So they start working together. They both got equal shares in the company. After 4 months, the finance founder says, you know what, it's not working for me. I've got some other opportunities I'm going to pursue. So see you later, CTO. I'm out of here. Good luck. So he walks away. He never had any sort of vesting on the shares that he got, the 50%. So he actually walks away with 50% of the company and no obligation to continue working for the company at all. So now you've got the CTO founder left with 50% of the company, and that CTO is stuck because whatever he does to grow the company, he's always going to have this other 50%, at least initially, with someone who's not contributing at all. So anyway, short story is incentivize your folks, the founders included, employees, advisors, consultants, incentivize them to stay with the company. How do you do that? Well, if you're going to give them a piece of the company, then you put in place vesting conditions so that they have to stay with the companies for a certain period of time in order to vest in their options or in order for the vesting on their restricted stock to lapse. And very quickly, the way it works is for stock, basically, if you give someone stock, it's restricted stock. The stock comes with the company's right to repurchase that stock if that person leaves within a certain time frame, before their stock is fully vested. And so, example, the finance founder who took off, if you had the right documentation in place, once that person decides they're going to leave, their relationship with the company terminates. The company then has an option to buy back that stock at the same price that the person originally bought it, which is typically low, which is good for the company. So now he can walk away with whatever stock vested, but any unvested stock he doesn't get to keep. So typically vesting schedules oftentimes are over a 4-year period with a 1-year cliff. And essentially that means that for the first year, they have to complete an entire year's worth of work with the company in order to vest in 25% of the stock. After the first year, the stock will continue to vest equally over, each month over the next 3 years until 100% is vested. So that way, you've got someone that is incentivized to stay with the company for at least the next 4 years. And if they decide to leave earlier, they are going to give up some equity that they have. So very important. Other things you don't think about are transfer restrictions. So when you're setting up the company, think about what sort of restrictions you want to have in place. So what can people do with the stock? There are securities issues that come into place. You want to be aware of those, but you also want to make sure that you don't allow people to just, come into the company and then decide, I'm helping build the company, but yeah, I'm not really interested. I'm going to go ahead and transfer my shares to my uncle, and my uncle has no interest in the company, isn't going to participate, is really not going to be a benefit to the company in any way, shape, or form. Doesn't really make sense to allow for a lot of those sort of transfers, even if they can be done in compliance with the securities laws. Oftentimes you want the company to have some sort of say so or some sort of restrictions on the stock being transferred. Okay, so let me take a quick look at, okay, so a couple quick questions. In between Canada, Inc. and Delaware, which one is preferable? That's a good question. I mean, if you're talking about forming in Canada versus forming in Delaware, those are two different worlds, right? Two different countries, completely different set of laws. What I can say very quickly is look at the base or your target investor. If you really are wanting to set up operations in the US and you want to target VCs in the US, you typically are going to want to create a US entity. It's not always the case, but oftentimes it is. It just is sort of naturally flows that people that are investing in companies want to invest in areas that they are familiar with. So typically, if you're a US VC, you typically want to invest in the US because you know the laws, you know the circumstances, you know the issues. Same thing in Canada. If you're based in Canada, investors are in Canada, you probably want to set up a Canadian entity. Another quick question, where does the cap table fall? So I'll get to the cap table in a minute. We will address that. So keep these issues in mind because this will become important as we talk about the cap table. Okay. Let's talk about different types of financing options. So early on in the company's life cycle, oftentimes the founders will bootstrap the initial expenses of the company. So they'll put money in from their own pocket to cover some legal expenses, accounting expenses, get things rolling. But fairly quickly, they're going to need cash, and they're going to probably need more cash than they individually can put into the company. So what oftentimes is called the family and friends round is usually the first round of financing you'll see that a startup does. Not always, but oftentimes it is. You go out to basically your friends and family and say, hey, look, got this great idea. I need some help. Can you write me a check and help seed our startup so we can get to the next stage? There's no real rule of thumb about how much you can raise in a family and friends round or what's the minimum. It's really totally open to your contacts, right? I mean, if you have really wealthy contacts and they're willing to put in, 3, 4, 5 million in a family and friends round, great. Some people have those contacts, some people don't. But the point being is those early financings are oftentimes done using a couple different vehicles. One of them is called convertible debt, or actually both of them is convertible securities, and they break down into convertible debt or convertible equity. And I'll explain that as we go. Convertible debt is essentially like a promissory note. So imagine that you go out to your aunt and say, look, I'm starting up. I need $300,000. The aunt has it. They've always been really happy with what you've done with your life and the sort of things you're creating. So they want to help support you. So they write you a check for $300,000. One way to do that is to have it be in the form of a promissory note. So they give you the cash, you give them, the company gives them a promissory note that's convertible. So at some point in the future, that note will convert into shares. And there's all sorts of features of that. We'll talk about that. But they're also called bridge notes or bridge financing. Pretty effective, pretty easy, and cost-effective way to get financing. And it pushes down the road issues about having to price your stock out and things like that we'll talk about. The next type of financing option you'll oftentimes run into is convertible equity. Probably the most common one that you've heard of is the SAFE. And it's an acronym that stands for Simple Agreement for Future Equity. This was an instrument that was created by Y Combinator, YC, if you're familiar, back in about 2013. It got a lot of traction in the startup ecosystem initially in Silicon Valley, and then it started to spread out throughout the rest of the US. Probably more common in the US. I've seen some people in other jurisdictions outside the US be familiar with it and use it. It's gaining a little bit more traction overseas, but in some areas it's not as well known. But it is a very effective vehicle instrument to use. It's short, sweet, it's cost effective to do, doesn't require a whole lot of documents, doesn't require a whole lot of expense. And what essentially it does is it has the investor put money into the company with a right to convert that money into shares when you do your next financing. And the next financing is defined, but essentially what happens is they say, look, I'm gonna put $100,000 into your company now. When you do your first financing, generally you're selling preferred stock or stock, then it'll convert into that stock when you do that next financing. So that next financing could be a few months away, it could be a year or so away or more, but generally it gets those early investors in on sometimes very favorable terms, which we'll talk about. And then the third option is oftentimes referred to as, equity round or priced equity round or venture round. And essentially what it means is you're selling stock in the company. So in this case, it's different. You're not selling a right to get stock in the future. You're actually selling stock on the day you close your transaction. And generally speaking, it's going to be preferred stock, especially if you're talking about a VC financing. VCs, sophisticated, experienced, they don't typically want to buy common stock. They want to have a way to protect their investment. And so they want preferred stock because preferred stock comes with rights, preferences, privileges, powers that the common stock doesn't have. And that's a way that they can effectively protect their investment by having preferred stock. We'll talk a little bit about that, but typically these are called Series Seed, Series A, Series B, Series C, and so on. The earlier stage obviously starts, with Series Seed, and then it's A, and then it goes sequentially. Typically, sometimes you'll see a Series A1, Series A2, but essentially it's going from one round to another, and each round will have its own preferences, privileges, rights, obligations, etc. Okay, so those are generally the three types of securities. So we talked about convertible securities, convert to equity at a negotiated discount in a qualified equity financing. So let me unpack that a bit. So essentially, it's this concept of either a convertible note or a SAFE, as I mentioned. But basically, you've got a right to get equity in the future at some sort of negotiated either discount or formula now, so that when the company does its next qualified equity financing, that'll be a defined term in the agreement. That's when your investment converts or the investor's investment converts into shares. So what this does is it avoids valuing the company's stock. And this is really important because the longer in some cases, the longer you can push out that valuation, the better, because there are a number of things that go into coming up with a value for your stock. If you're going to be doing, and let me go off on a little bit of a tangent. If you're going to be setting up an equity incentive plan, so you want to be able to give employees, founders, employees, advisors, consultants, some sort of option or equity in the company, but particularly options, then you're going to have to set up a plan. There are all sorts of requirements to set up the plan. And you need to be able to value the common stock at fair market value, because there are tax rules that come into play that say if you're going to grant an option to someone, you got to grant it to them at fair market value. So you need to come up with a value of the stock. That requires a valuation, which can be in some cases expensive. But then now you've got a price point on your stock, at least your common stock. So as soon as you get a price point on your stock, you've got to make sure you stay aware of that, and you can't jump around and start pricing things up and down. So if you go out and get a valuation, you set up an equity incentive plan, the valuation comes in at a penny a share, and then next week you decide, oh, I'm going to bring some other people on, but you know what, I want the value to be more, so I'm going to sell it to them at 10 cents. And then a few months later you decide, oh, well, you know what, no, that was a little bit too much, I'm going to sell it to them at 5 cents. What you're creating is all sorts of problems, because now you've come up with several different valuations. And unless you could properly justify that, there can be all sorts of tax ramifications for not properly valuing your stock. It also creates an issue from an investor's perspective. An investor coming in, especially at a VC round, looking at your books and records, if they see this sort of very flippant approach to pricing your stock, they're going to raise that in their diligence, and their attorneys are going to raise that as potentially problematic. So the benefit of having a convertible security early on is you don't have to worry about valuing the stock. The value will be determined once you have that next financing. As I mentioned, it's a lot easier to document, less expensive than doing a venture round, for reasons I'll explain. But in short, there's a lot less documentation that goes into doing a convertible security round. So a convertible note or a safe, it's a lot easier, a lot quicker. There's usually less diligence done because it's done oftentimes at an earlier stage, not always, but oftentimes. So it's a much faster process. So as an example, you might be able to get some sort of convertible financing done, within a week, if everything goes perfectly as planned and there's no hiccups. Whereas if you actually do a priced, like a venture round, I've seen those go fairly quickly, but generally speaking, I would be very hesitant if anyone says, oh yeah, we can get this done in 2 weeks. I mean, at a minimum, you want at least 30 days, and more realistically, probably 45 days or more, depending on who the investor is, how many investors you have, how long the company's been around. There's just a lot that needs to be looked at and reviewed. And then you've got more documents to negotiate and go through. So we'll go into that a little bit, but essentially those are one of the benefits. The downside is on a convertible security is if it's a convertible note, it's debt. So it's going to show up on your finances as debt. You owe that money back to the investor. Now, typically investors don't want that money back because they want to be able to convert into securities at a later stage. Otherwise, if they were going to get their money back, they would have chosen some other, they would have bought bonds or something else that maybe would have given them a better return. And the other issue is basically it has this what I call an extra liquidation preference, because it is debt. They're going to get paid if there's a problem, the company has to liquidate or dissolve. Because it's debt, they're going to get paid before any of the equity investors. So any of the founders that own shares, before the founders can get paid, you've got to pay your liabilities. And a note is a liability, so you'd have to pay the holders of your convertible notes first before you could take any money. So in that sense, it has this extra liquidation preference, if you will. Okay, so other issues with convertible securities. Some apply to safes, some apply to convertible notes. Maturity date, interest rate, those are specific to debt, specific to convertible notes, not to safes, because those two issues or those two provisions are essentially part of what defines a note, right? It has a maturity date, you owe the money back at a certain point in time, and it'll accrue interest at a certain rate. There are conversion terms, which is essentially how you determine what the amount of the investment converts into, how the instrument can get amended. So can you go and amend your note or your safe? Do you have to get everyone's consent? Do you have to just get a majority of the people that invested using safes to consent? That's an important factor too. And keep in mind, oftentimes when you're doing this type of financing, you're going out and raising a bunch of money from multiple people. So it's not as if you're giving one person a safe document and they're going to be signing it, sending it, putting a check in. It's actually oftentimes you go out to multiple people to raise a round using this type of instrument. So knowing whether or not you can amend the terms by just getting a majority of the people that hold the notes can be an important provision for you. And the remaining terms, those are oftentimes aren't heavily negotiated, but there are some other terms that come into play there. Okay. Let me move on here. And so let's talk about conversion terms, which oftentimes with a convertible security, this is really where you want to be focusing, right? It's looking at what are the conversion features of that instrument. So oftentimes with, whether it's a convertible note, oftentimes with a safe, you'll see that there might be some sort of a discount price paid or a valuation cap. These are really nice for the investor because it means essentially that they're going to be able to get the stock. They'll be able to convert the stock in, or their investment into stock at some sort of a discount. And the discount comes into place because they're actually getting a discount off of the price that's paid by the investors in the next round. So if the VC round is $1 a share and they've got a discount of 20%, they're going to get the shares for 80 cents instead of $1. So it can be a sweet deal for them. And there's also this concept of valuation cap, which you can set the valuation cap, which will be used when you do your pro forma to determine the price. And if the valuation cap that's in the safe is lower than what your valuation is in your financing, then that also acts as a way to get a discount. The price will be lower for the investors that have a valuation cap that's lower than the actual valuation that you have for your company in the financing that you're doing. Okay, let me see. Oh, and I should have mentioned, my apologies. We are recording this, so we will make the recording available shortly after the presentation. We'll send you a link. You'll have the link to look at. So yeah, if you weren't able to attend all of this or part of this presentation, don't worry, it will be sent out. You'll have the ability to review it at a later date. Okay, I'm sorry, I'm just looking at a couple quick questions. Okay. So what form do you have your shareholders fill out to defer tax costs? That's a good question. So when you're first starting a company, the founders that are putting in money to get shares for the company, typically that's what's considered a tax-free exchange because they're paying value for the stock that they're getting in the company. And as long as it's done properly, there typically isn't any tax. So the founders, let's say putting in $100 to get 1,000 shares or 1,000,000 shares, depending on the price, they're not going to get taxed for getting the shares because they paid for it. So I'm not quite sure exactly what you're referring to as far as tax costs. The tax would come up, if you are someone who's gotten options in a company or you've received restricted stock, and then at some point in the future there's a sale, so there's going to be proceeds that'll be distributed out. Obviously, there'll be tax event at that point, and then there are some elections you can make to pay the taxes now on restricted stock versus at a later date, and we can touch on that a little bit later, or feel free to reach out to me separately on that. Another quick question, and then we'll continue on. So this question says, I'm raising a rolling pre-seed round of 250, 30K minimum and setting up Carta. Do most founders do it themselves? Where to get affordable help to set up your right? Great question. I mean, Carta is one of a few companies that helps you manage your cap table. We use it all the time. I would say they have a pretty good help system. So if you're not quite sure about something, you can call them. I would try to use them as much as you can. And if you get stuck, oftentimes the attorneys will be able to help. Either the attorneys or the paralegals are really good at helping you understand how to get all your data into Carta and make sure that it's managed properly and updated. Okay, let's go back to conversion terms and talk about the rest of this. So we talked about mandatory conversion at a discount price in the next financing. So it should happen automatically. So if you've got a safe or convertible note, it'll convert once there's a next financing. And we talked about, let's assume it's a Series C or Series A, that's the next financing. There'll be a definition of what is a qualified financing. And as long as that definition is met, then that instrument will convert, the investment will convert into shares. And it'll either have a discount. Typically, I see discounts anywhere from 20 to 25%. Anything more than that is not really market. I've seen people ask for 30% or more. That's a really rich ask, and oftentimes that's going to be problematic. I usually see 20, 25%. There can be conversion upon a change in control or sale of the company. So, you start your company, you get some safes, and before you even get to your first venture capital financing, you get a really sweet offer to sell the company, so you sell the company. Oftentimes, the safe instrument or the convertible note will have a provision that says, look, if there's a sale of the company, then here's what happens. You get paid X dollars based upon the valuation of the company and the proceeds and all that. So that's an important feature as well. In some cases, these convertible securities can have an optional maturity conversion. So basically, the investor at some point, or in some cases, the company can actually choose to convert the investment into shares. So that's another feature you might oftentimes see. Okay. Let's talk about some foundational basics, valuation dilution. When you're talking about positioning your company for a venture capital round, or really any kind of financing, but especially a venture round, you want to understand some of these basic terms. So pre-money valuation, post-money valuation, issued and outstanding basis, fully diluted basis. What are those? What do they mean? What should you be thinking about with regard to these terms? So pre-money valuation, as it says, is basically the value of the company before the next round of investment. It's a value you come up with before you go out and get your investment. And that's important because that's going to be used in part to drive what the purchase price will be that the investors are going to pay. Your post-money valuation is the value of the company after the investment is made. So as an example, if you've determined your company has a valuation, pre-money valuation of 10 million, and you're going out to raise 5 million, then once the 5 million comes in, your post-money valuation is going to be 15 million. So it's the pre-money valuation of 10 plus the new money coming into 5, the post-money valuation will be 15 million. Issued and outstanding basis refers to all of the stock of the company that's issued and outstanding as of the time you're looking at it. So you're not talking about options, you're not talking about convertible securities, so safes or convertible notes or warrants or anything like that. We're just talking purely about right now, as you look at the cap table, who are the actual owners of shares in the company. That's called issued and outstanding basis. The next term that's important to know is fully diluted basis. What does that mean? So essentially, that's the issued and outstanding basis, plus you include in that calculation all of your convertible securities. So typically it's options, it's warrants, which is similar to an option, and it's any other convertible securities such as a convertible note or a safe. So you assume that all of those convertible securities have converted into shares, and then you look at your numbers and say, okay, if everything's converted, everyone's gotten stock now. Now I'm looking on a fully diluted basis, who owns what shares in the company. So you want to become familiar with those, and you want to become familiar with looking at your cap table and understanding it, on a issued and outstanding basis, but also on a fully diluted basis. So example, I kind of went over this already, a little different. Your pre-money valuation is 10 million. You have 10 million shares that are split between 3 equal founders, and they each have 33% of the company. There is a $3 million investment made. So your pre-money valuation, 10 million, you divide that by the number of outstanding shares, 10 million. So your price per share is going to be $1, right? 10 million divided by 10 million is $1, is 1. So there's 10 million pre-money valuation. You're getting an investment of 3 million. Your post-money valuation is going to be 13 million. So when you look at that and you do the calculations, founder A, let's say, who has 3,333,000, et cetera, approximately 25%, with a value of about 3.3 million. Okay. Oops, let's see. Okay, so here's some basics with convertible securities as well. I'll kind of try to run through these a little bit quicker. And there's one question on interest rates on convertible securities. Good question. So interest rates they're typically pretty low because, as I mentioned, the investors making an investment via a convertible note typically aren't looking to make money on the interest. They're really looking to convert into shares. So I've seen anywhere from whatever the minimum applicable federal rate is, but generally it's anywhere from 4 to I'd say 8%. In that range, probably not more than that. Okay, basic examples for some convertible securities. So if you had 450,000 convertible security with 25% discount, the holder would have received 600,000 shares, right? If you look at that with a discount. There's this issue about circular math. I'm not going to go into that. I'm happy to talk about it offline. But essentially, once you calculate it out, you understand that if someone's getting a discount, in this case 25% discount, they're going to get their stock for a nice discount as opposed to the people that are buying it for the regular price. So the discounts and the valuation caps can be really helpful for the early investors. And it's also helpful to attract them too, because if you offer these, sometimes that can make the difference between getting an investment or not. Another example, if there'd been a 450,000 convertible security with a $5 million valuation cap, the holder would have received 900,000 shares because if the company has a valuation of 10 million, but your valuation cap is 5 million, then you're going to use the 5 million in calculating what the purchase price is going to be, not the 10 million. So if you did the 10 million, right, it'd be 10 million divided by 10 million. That's $1 a share. But if you divide the 5 million, which is the cap you have on valuation, which is less than the 10 million, when you use that calculation, you're going to come up with basically stock at half price. They're going to be able to get a really nice deal on that. So knowing that and understanding how that math works is going to be important. Because when you do your venture round, you're going to have to create a pro forma that's going to essentially track what everyone's going to be getting in this investment. So you need to be able to go through and say, all right, if I've got safes, the holders of the safes are going to convert based on their formula and their document. If I've got convertible securities, the holders of the convertible notes, they're going to convert at this. And then the people that are buying stock in the venture round, they're going to get, the stock at X price. And you need to calculate that model out in a pro forma, so you know exactly who's going to be getting what when the deal closes. Okay, let's talk a little bit about venture financings, overview of what they are. What are some things you should be thinking about in order to best position your company for a venture capital financing? So one of the first things that I always think about is you really have to have a credible business plan with milestones. You've got to have a compelling story to tell an investor. The one thing, and especially for our audience today that are first-time entrepreneurs, if you haven't been through this process or you're not familiar, if you get to the point where you're going to go for a venture capital round, the venture capital investors by far and large are very experienced. They've generally, if they've been around the community, they've done a bunch of deals. They've done a whole lot of deals. They've negotiated a lot of deals. They understand the analysis that goes into companies. They understand the market. They understand what the drivers are. So they're coming into this situation with you, looking at your company with a tremendous amount of experience. So you need to be able to convince them. You need to be able to tell them a great story, and you need to be able to show them that you have a credible business plan, and you've got reasonable milestones. You've got a solution to a need, and also that your company is something that is scalable. So that's probably one of the first things, is make sure you've got something that's going to be really compelling. And you can test this out with friends that are investors, or if you know VCs and they're willing to sit down with you and you kind of tell them what you're thinking about, and they can give you some great advice initially. That oftentimes is very helpful too. The other thing I'll tell you is run what I refer to as systematic process, right? So go through a process of making sure you're setting yourself up for success. So what does that mean? Make sure you've got enough capital from your prior round to get you through your venture round. Oftentimes, if you're not balancing your budget carefully, if you're not careful with your expenses, you raise a family and friends round. Let's say you raise $1 million from family and friends on a safe or a bunch of safes. You got $1 million in the bank. You think life is great. You start going out and you go get office space and you go buy a bunch of equipment and computers and all this other stuff. You've spent a bunch of that money, and you didn't realize that, you need to get your technology or your business plan far enough along so you've got some sort of story to tell and something to back it up with. So you've either got a prototype, proof of concept, you've actually got demonstrated sales or pilot projects that are showing positive results. You've got something to demonstrate to the investor that, look, not only is it a great idea, but I can show you that it actually works. I mean, here's the concept, here's the prototype, here's the pilot projects. We've gotten all these wonderful raving reviews from all these companies. And if you didn't plan it right, you run out of your $1 million before you can get to that point. Now you're stuck because you don't have what you need to be able to go to the VC to seal the deal. So make sure you're balancing that, and you know how much money you need to get from point A to point B. Point A being closing of your family and friend round to closing of your venture capital round or your next financing. Connect with the right investors. You know, this also goes without saying, but there are so many investors out there, and you want to make sure you are getting in front of the right ones. So if you've got a technology company that's sort of a SaaS-based model, and it, you know, is in a very specific field, then you want to be talking to investors that know that space, right? If you go talk to an investor that looks to invest in brick and mortar type investments, probably not the right investor. Now, I'm not going to say never, but you know, if they don't understand your model, they don't understand your business or industry, they're going to be less likely to make an investment. Understand your ideal term sheet. That's really important too. There's a lot of examples out there I'll talk about in a moment. But now is the time, well in advance of doing your round, or even starting to talk to investors about a round, to do your homework, to really sit down and start reading as much as you can. Listen to webinars, go to events and presentations, go to pitches so you can hear how other people are pitching. But really understand what it is that investors are looking for, and what typically you can expect to see in a term sheet, what provisions you can typically expect to negotiate, what's more favorable, less favorable, et cetera. Understanding that term sheet is going to be really important. Prepare for thorough diligence. Can't emphasize this enough. I've seen it over and over the years I've been practicing. Companies typically put that on the back burner. I'll get to organizing my documents. I'll get to setting up a data room. You know, I don't know where the signed documents are. Some of them are signed. Some of them are not dated yet. Yeah, I'll figure all that out later. And then suddenly you get an investor. You're negotiating a term sheet. You sign a term sheet, and boom, they're off and they're asking for diligence. And it takes you a week, 2-3 weeks to get stuff organized to deliver it to them. Not a good look for the investor, you know, from the investor's perspective. But then you also have the chance you've missed something, something's fallen through the cracks. So prepare all that stuff now. It's easy to do and get in place, and then it makes your life a lot easier down the road. Have good corporate hygiene. So make sure that basically you have good, clean set of records. You've gotten proper advice from your lawyers, from your accountants, your tax advisors. Everything's there, it's done properly. So there aren't any big red flags that investors are going to see when they start doing diligence on the company. Okay, talking about your term sheet. You know, what is in a term sheet? It's essentially, if you're not familiar with the term sheet, it's the relatively short document that you're going to get from an investor, or you'll present to an investor, that is going to basically provide an overview of the main terms for that investment, for that financing. So how much of the company is being sold, you know, typically it also talks about are the preferred stockholders. Remember, if you're doing a VC financing, typically VCs are wanting preferred stock, and preferred stock comes with those rights, preferences, privileges that I talked about. One of those is a dividend, having a dividend, getting a dividend, or having a dividend right before the common stockholders. So dividends, liquidation preferences essentially is if there's a liquidation or a deemed liquidation, which could be a sale of the company or an IPO, what have you, and there are proceeds to distribute, who gets that? What's the waterfall? Where does the money go once you have a sale of the company? And let's say you sell for, you know, $100 million, you've paid all your liabilities, you're left with 75 million. Where does it go? Well, there's going to be what's called a waterfall. You know, as the water falls down, as those proceeds, the $75 million fall down, trickle down, who gets the first slice, who gets the second slice, who gets the third slice? That's oftentimes where you'll see your liquidation preference will say, you know, if you've got a Series A investor, that they're gonna get their money back, their investment back before anyone else gets paid, or maybe it's their investment plus something else, or maybe they'll get the greater of their investment, or whatever they would get if they converted to common stock and shared the proceeds with the common holders. So there's a number of ways that can work, but it's an important issue to look at. Voting rights, protective provisions. Protective provisions are essentially what sort of decisions can the company make, or what sort of decisions or actions can the company take that requires, you know, some or percentage of the preferred stockholders to consent to. So if you remember early on, I said the investors are typically looking to protect their investment, their dollars are putting into the company. This is one of the ways they do that. They put some restrictions on the company's ability to do certain things unless they agree to that. So oftentimes you think of the big ticket items. If you're going to sell the company, if you're going to go out and take a huge loan, if you're going to go out and do something that could potentially impact the investor's money in the company, their investment, that's oftentimes where they're going to want to have some sort of protective provision. That's oftentimes negotiated, but it's important to balance that out between what are the investors going to require versus what is not so restrictive that the company can't even, sneeze with, the founder can't sneeze without getting the stockholders' consent. So it's a little bit of a balancing game, but oftentimes negotiated at the term sheet stage. Optional mandatory conversions, similar to when I talked about convertible securities, when do those convert? Same thing with preferred shares. So preferred stock, by its nature, is a convertible security. It's a security that can, under certain circumstances, convert from being preferred stock into oftentimes common stock. So that's important because what are the mechanisms for the conversion to take place? What are the milestones or thresholds? That's an important feature to understand as well as you're thinking about this term sheet. Anti-dilution protection. This is pretty common as well. So an investor that's putting money into the company wants to know that they can protect that and not get diluted over time. So if they put in $1 million now and they got 10% of the company, and then you go raise more money, down the road, 2-3 years, you've done a couple more rounds, their 10%, unless they've also had the chance to participate, their 10% is typically going to be diluted down. So they may end up with less than 5% or 4% or 3% in a few years if you raise more money. And the more money you raise, oftentimes the more dilution the existing stockholders will have. So one way to protect against that, there's a couple different ways, but one of the common ways is you basically have what are called these anti-dilution rights, so that if the company goes out and sells more stock in the future, you first have to go back to the existing stockholder and say, look, we're going to go sell some more stock. You have 10% of the company. You have the right to buy enough stock in what we're going to be selling now to maintain your 10% ownership interest. What's called preemptive rights or pro rata rights. It's the ability to be able to participate in a future round and buy enough stock to maintain your ownership interest. That can be an important factor too in the term sheet, and sometimes negotiate as to what those provisions may be, how they're triggered. Vesting for founders. I mentioned this early on, especially VCs, but your sophisticated investor is going to want to make sure that you as a founder have restricted stock that's going to vest over time. So you're going to stick around. Is the example that the CTO took off after a few months and took 50% of the company without any restrictions. Investors don't want that to happen. Documentation, typically there'll be a suite of documents that will be part of the financing, and I'll talk about that in a minute. No shop and confidentiality provisions in the term sheet. These are probably the two provisions that you might see be binding in a term sheet. Oftentimes a term sheet is non-binding, so it's a time to get together, negotiate the material terms, but it's not an actual commitment and an obligation to invest for the investor or for the company to sell the shares until you've got the definitive documents and it's signed and everything's sealed and delivered. And then obviously the investment comes in and the company issues the shares. So the term sheet oftentimes is non-binding, but the two provisions you might see that could be binding are a no shop, which essentially is really for the investor, and it's the restriction on the company to go out and go find another investor. So if they're talking to you, they're putting in time and effort, they want to know that you're not going to talk to them, and then half an hour later you walk across the street, go talk to another investor and say basically, yeah, I'm going to go with you instead. That we see that oftentimes. You want it to be fairly limited duration. Oftentimes it's dictated by the investor, but you just want to make sure it doesn't become a major handicap. So if things don't progress the way they should with the one investor, you're not hamstrung and you can't go out and start getting other investment from other investors. Confidentiality is important. If you're going to be disclosing stuff, you want to make sure you've got some confidentiality protections in place. VCs typically will not sign an NDA, but they oftentimes will sign have a confidentiality provision in a term sheet. So if they're serious enough about investing and they've signed the term sheet, then they oftentimes will agree to confidentiality provisions. Some of the other things you can think about is whether or not they're going to get a board seat. That's something that can be negotiated between the parties, and oftentimes is, depending on the size of their investment. Let me take a look at the questions. Let's see, how do founders initially issue shares to themselves or early employees? Card of service, including such feature. I wonder if anyone has used it. Yeah, that's really important. There's another presentation I've done on how to, I think it's how to prepare for a financing. And I talked a little bit more about how to allocate shares between founders. There's also a presentation I've done on how to avoid big startup mistakes. I talk about that there as well. That's a critical issue. You want to make sure that you have very frank, transparent discussions with your founders before you form your company. Make sure you know who's putting in what, who's going to contribute what. Make sure it's fair to everyone so that afterwards you don't have tension build up because the allocation is not set up and one person got more shares, they're doing less work, contributing less than the other person who's really working hard but didn't get as much. You know, do you allocate the same amount to someone putting in money versus someone putting in technology, or someone who's just there because they've got great contacts and background and understand finances really well? So you got to make sure you have those discussions. It's kind of like dating, get to know your co-founders really well, understand pros, cons, strengths, weaknesses, and anticipate where there might be some tension or issues. And once you've worked out all that, come up with an allocation that everyone believes and thinks is really fair. Okay, so talking about venture financing's overview a little bit more. Diligence process, and I know we've got a few minutes before 10, so we'll open up for questions around 10. But essentially the diligence process is after you sign your term sheet, that's when the diligence process really starts. So the investor and the company sign the term sheet. The investor is going to say, okay, great, we're excited, we want to go forward, we're looking forward to investing. Let's take a look at your documents. Let's do our diligence, make sure we understand everything we need to understand to feel comfortable investing in your company. And that can be an exhaustive process. It can be a pretty involved process. It can take weeks and weeks, depending on how much documents you have, how long you've been around. If your organization is really good, if your documents are in really good shape, you've got good corporate hygiene, as I mentioned, that can speed up the process. But essentially, it's the investors and their attorneys looking at the company, kicking the tires, turning over every stone, making sure there's no skeletons in the closet, red flags that come up that could be a real problem. So for example, they oftentimes will want to look at your cap table. They're going to want to tie out the cap table, meaning they're going to want to go and say, okay, you're telling me that you've got all these people as shareholders, you've got a bunch of people as option holders, and you also did a couple safe financings last year. Now I need to see all of the underlying documents to actually confirm that your cap table is accurate. It's true and accurate as you've represented it. So you need to find, for a safe investment, there needs to be the safe document that you have signed, dated. There should be board consent for the safe. For, let's say options, you need to have an option plan that was properly set up with whatever filings are needed. Did you have board consent for the grant of the options? If the founders got restricted stock early on, or if they got stock when they set up the company, is it restricted? Are there vesting conditions? Did anyone who's contributed to the IP of the company or the development of the company sign an invention assignment agreement? All of that stuff, including the technical part of looking at your IP, if you've got patents, trademarks, what have you. That's a huge part of the process. The documentation I mentioned a few minutes ago, I talked about for a venture capital type financing, you typically can expect the suite of documents that I mentioned. So it's the purchase agreement, your restated certificate. So your certificate of incorporation will need to be restated to build into it the class of shares you're going to be selling the preferred stockholders. And if you're going to be having safes that are converting, if they're converting at the same price as you're selling the stock to the venture capital investors, then that's easy. They're going to get the same Series A, Series C, Series A stock. However, if the safe holders have a valuation cap or a discount that's going to get triggered, and they're going to be buying the stock at a lower price than what the investors in the new round are buying at, then you need to create what are called a shadow series of preferred shares. So let's say it's a Series A round. The VC is going to buy Series A. You've got a couple other investors buying Series A. You've got a safe that's going to convert, and it's going to convert at a 20% discount. So instead of $1 a share, the safe holder is going to be able to convert their shares at 80 cents a share. So because that difference, that discrepancy in the purchase price, you have to build a mechanism into your charter, your certificate of incorporation, to allow that difference to be factored into the different provisions. For example, dividends, liquidation preference, et cetera. So you might have a Series A preferred, and then the safe holder might get what's called a Series A1 preferred. Anyway, I can talk a little bit more about that offline if people have interest or questions about it. But essentially, it's the purchase agreement, the restated certificate, investment rights agreement, right of first refusal and co-sale agreement, and a voting agreement. They all do different things, but essentially it's all there to sort of, encompass the financing. The right of first refusal, that addresses issues about if the company is going to go out and sell stock, or if they're key holders, like the founders oftentimes, if they're going to go and sell stock, sometimes investors want a right to be able to buy their stock before they can sell it to someone else. The investor rights agreement oftentimes will have special rights in there, information rights, inspection rights, other rights that the investors will have. And then the voting agreement oftentimes will indicate how the votes will be. So if you have preferred shares A or in A1 or B, they can vote differently. They can vote to elect, for example, a Series A director or a Series B director. So that will indicate the different types of voting issues that you need to be thinking about or that were negotiated between the parties. There are some great forums, and I'm going to wrap up in a minute, but there are some really great forums at the National Venture Capital Association. If you're not familiar with this site, definitely check it out. It's nvca.org. They're probably the preeminent organization for venture capital financings. They've developed over the years a set of model forums that are great. They're really well done. They're reviewed on a regular basis by a number of different law firms, by a number of different venture capital firms, and they're updated. So you can expect really well thought through provisions that are fairly balanced between the investor and the company side, with options to select some more favorable to the company, some more favorable to the investor. But they provide annotations, so they explain why certain provisions are there. Great resource. I can tell you that a lot of times for venture capital financings, those are the go-to documents. Those are the forms that are typically used. There are other forms. Series Seed has a set, and then some law firms have their own proprietary forms. But typically what people look to, especially on the terms that they would consider what's typically market, oftentimes they'll look at the nvca.org documents. Really quickly on closing. Closing, you want to start preparing for closing from day one. Don't wait to be behind the eight ball. You want to get everything organized, ready, so that you can have a clean, efficient closing. And then there'll be some post-closing items that you'll want to be aware of. I have this sort of mantra about ABC: always be closing, always be thinking about closing. So do your homework. Make sure your company's house is in order before you talk to investors. We talked about making sure cap table is accurate. You have a pro forma. Your data room's up and running. You've done your own diligence. So you do your own diligence, act as if you're the investor, and try to find problems within your company so you can correct them now rather than having the investor point them out. Prepare from day one. Create your team who's going to be working on the deal, internal and external. Make sure you've got good counsel. They're instrumental in your financing. Set a reasonable timeline, and then organize and divide tasks appropriately so people aren't overburdened. Make it efficient as you can. Really quickly on common pitfalls, and then I'll start going through some questions. Not complying with securities laws. You got to make sure you comply with the securities laws. It's important. Some issues, if you haven't corrected them in the past, can be corrected, but that's the reason why you want to make sure you go through and do your diligence before the investor does. There may be some, if you're in a particular field that's regulated, if you're a healthcare company or if you've got a biomedical device or something, that could be highly regulated. You want to make sure you're looking into those, you're complying with whatever those issues are. Not managing your cap tables. You've got people that own stock that aren't reflected on the cap table. You've got people that don't have the right number of shares, didn't sign the right documents. You think that, well, these documents are all standard, right? So it doesn't really matter. And you don't have the right invention assignment provisions in your agreements with your founders. Like the example I gave early on about the CTO who takes off and owns the technology, it never got transferred over. If you're using finders, you got to be really careful with that. Get really good counsel that understands, the securities laws that govern finders. Side letters, not getting proper authorization to do things. Typically, the board has to provide corporate authorization for certain actions, and if you don't have it, that can be a problem. not forming the right entity, not having vesting agreements in place, not doing your employment issues properly. So now you've brought people on, you said, oh yeah, they're independent contractors because that's easier. I don't want to deal with payroll, but actually they're employees, and then they leave and one of them has an issue, turns around and files a complaint with the employment department, and now you've got a problem. Tax issues is another one too. So I know I ran through this very quickly. I wanted to make sure I got to enough of questions over the next 25 minutes or so. So let me go through some of the questions and see if we can answer some of those. Okay, so what is we talked about interest rates. So here's a question. I will be raising my first round of capital for my fintech Web 3.0 blockchain startup. I'm planning to start with the Carta's free tier service. Yeah, that's not really a question, but so Carta there's a couple other companies. We work with Carta a lot. They're a really good service. A lot of investors like them. A lot of investors understand them. A lot of VCs like their companies to be on Carta because it makes it very easy to look at documents and get updates. They do have a free tier service. That's great to start off with. You can always increase your service as the company grows. But if nothing else, it gets you to focus in on organizing and setting up things properly from the get-go. How do founders initially issue shares to themselves for early employees? I think we touched a little bit about that. So for the founders, that's the whole thing about dating, sit down, talk about what their weaknesses and strengths are, what everyone's contributing, how to allocate. But with regard to early employees, and I get this question a lot, is you want to be really careful. Oftentimes, whether the early employee is a really good friend, family member, or somebody you met you really like, you want to bring them in, you just want to make sure you're careful with what you offer that early employee or those early employees, because as you start offering things to employees, you're setting precedents. So the first couple employees you bring in, let's say you give me 10% of the company, now you've given away 20% of the company. That's a huge percentage of the company. And let's say you need another 5 or 6 employees you need to join at an early stage. What, are you going to give them all 10% as well? Now you've basically given away 50% of the company. So you want to be really careful. I mean, I can't tell you a specific amount because every circumstance is different, but generally, for early employees to bring them into the company, you got to look at the market and see what's competitive, but they usually aren't given a large percentage. It's really a very small percentage because you don't know if they're going to work out. So you can always give people more later on. And what I oftentimes tell clients that ask me the same question is, look, if they're really interested and want to work with you, give them something, give them a small amount now, but then as they grow with the company, as they show their dedication and service and value, you can always give them more later on. So you can grant options or you can grant restricted stock on an annual basis. You can give people a bonus in stock. There's a lot of different ways to incentivize people or to reward them. Be careful with what you give them early on from the get-go. What is the cost or timeline to issue shares to someone from via Carta? That's really a question for Carta. Once you have everything set up in Carta, I can tell you it's super easy. Once you get the board to approve an issuance or a grant, you basically go and you upload the information in Carta, and that will trigger, once the company approves it, it sends an email to the recipient. They get it, they click on it, they accept it, sign the documents, and you're done. And then they will get their shares. It's all done electronically. It's really a great way to manage your cap table. Okay. Yeah, the link with the recording will be sent shortly after the presentation. Here's another question. Our IP is with a foreign company with a single investor at 10% for $300,000. We set up a U.S. company for government grants and investments. The challenge is redefining the relationship between the two companies. Between the U.S. company to become the parent, with IP licensing from foreign or secondary investments into the foreign company. Thoughts are, yeah, so I would reach out to me separately. That great question. It's a complicated one, so not something I can really go into now, but there are a lot of issues you should be thinking about. So if you're in another jurisdiction outside the U.S. and you've got a company already outside the U.S. and you want to come to the U.S. market, there are a couple different ways to do that, and you want to make sure you've explored the different options. You've talked to good legal counsel. You've talked to a tax counsel. Or your accountant or tax advisor. You want to make sure that you've covered both of those issues because there could be tax issues that come up. You want to structure the the arrangement in the right way. So very quickly, oftentimes you can, if you're already established in another country, you could set up a subsidiary in the US, or you could do what's called a corporate flip. So essentially you set up an entity, a subsidiary in the US, and then the subsidiary and the parent, which is the foreign entity, will essentially exchange shares to do a flip so that the US entity becomes the parent and the foreign entity becomes a subsidiary. That can in some cases be a good structure, but it's complicated. The one thing I'll tell you about IP though, is be very, very careful. When you start creating IP that has value in one jurisdiction, if you then go and transfer it to another jurisdiction, you can encounter some pretty significant tax issues. So that's where you really need to make sure you get good counsel involved, in particular good tax counsel, because you don't want to necessarily transfer IP from, let's say, if you're in South Africa and you develop all this stuff, you've got patents and other things, and you want to then transfer all that IP over to the US, that can generate some tax issues for you. So be very careful with that. Another question, is the convertible note cap applied to the pre-money valuation before the next round? It depends on what the note says, but typically, yes, you would look at what the valuation is. So for example, the $10 million valuation, that's the pre-money valuation, the example I gave. If you had a $5 million valuation cap on your convertible note, then you would look at the $10 million pre-money valuation, and that would be what you'd look at to see whether or not you're going to be below that pre-money valuation, which in this example you would be, because the valuation cap is 5 million, less than 10 million. So you would use the valuation cap to calculate out the price per share for the conversion. Can you list what's required for due diligence? That is a long, long list. But anyway, I can summarize it really quickly. So if the investor is going to be doing due diligence on your company as you're preparing for your VC financing, they're going to oftentimes, their attorneys will send you what we call a due diligence request list or request list. It's oftentimes multiple pages, and it goes through all the different categories that they're thinking about, they want to understand. Corporate, employment, tax, IP, regulatory, potentially environmental. Those are the ones that come to mind, probably the big categories. And essentially, it's going to be a bunch of questions underneath those categories. So for corporate, for example, it'll be, send us all of your corporate documents. We want to see your certificate of incorporation, your bylaws, board minutes, board resolutions, stockholder minutes, stockholder resolutions, cap table. We want to see all of the security issuances that the company's done. So all of the stock purchase agreements where you've sold stock to the founders, early employees, advisors, consultants, consulting agreements, employment agreements. It'll include oftentimes all of that stuff. So as you can imagine, those lists can get long, and the more of those documents you have, the more cumbersome it can be. So my best advice is start now. And even if you think your first financing's 6 months down the road, start now, reach out to someone, get a list, and actually, as I said, role play. Pretend you're the investor and you're going through that list. Organize your documents according to that list. The lists are all different, but the general concepts and the general areas that the investors are focusing in on are all going to be pretty much the same. As I mentioned, corporate, employment, tax, IP. So you can go to those categories, start pulling all your documents together, go through your documents, make sure they're all, if they're agreements, they're all fully executed, dated, all the attachments are there, and then just put them somewhere in a folder on your computer, and then at some point organize them and put them up in a data room. And you make sure it's a safe data room. There are some really good choices there, but do your diligence on safety and all that. But that'll help you. I can't tell you how much it'll save you in time and money, because oftentimes companies come to us and say, hey, we've got our first financing, we're ready to go, we're excited, we just signed a term sheet, here's all our documents, can you tell us what we need to do now? And we're spending time at an hourly rate to go through and organize all the documents. Not a great way to spend your money. So if you can help shortcut that, you'll end up saving a lot of money, and you actually have a few less sleepless nights. Okay, let me check time. We've got another 15 minutes or so. Is it true you need to approach investors for advice? Investors you do not know, because if you ask them to invest, they will give you advice. Yeah, that's a great question. It's so funny, and I oftentimes use the analogy, if you're looking for a job, I've always found if you go to someone and say, hey, I'm looking for a job, do you have any openings? You most likely are going to get rejected because people just don't like to be sold. They don't want you coming to them trying to sell them something, even if it's, selling them yourself for a position in their company. Everyone gets bombarded, right? How many emails do you get about buying this or that? Or how many times does someone come up to you and say, hey, can you buy these? Can you buy that? And you say, hey, you know what? I'm gonna block you. That's spam. The better way to do it is oftentimes is go find someone in a company you really want to work at and go and talk to them, strike up a conversation. Don't ask them about whether they have a job, but ask them, well, what do you like about this company? I'm really interested in your industry. I really like what the company's doing. Do you have a few minutes for me? I'd love to know more. And try to establish a bond with us, try to establish a relationship so they're not just thinking about you as, what do you want from me? You want me to give you something. That way you've got a much better chance of having them have a good conversation with you. It's the same thing with investors. If there's a way to connect with an investor over an interest, over a connection, over an idea, an industry, something like that, that's oftentimes a great way to strike up a conversation. And then once you've established that relationship, it's much easier to then, when you're talking about yourself or talking about your company, if there is a need there, it's a much easier ask at that point. So yeah, that was a great question. How much in legal fees for a small offering? I think it was 5 million, if I'm reading the numbers right. The screen's a little small. That's hard. I can't give you a real decent amount because it all depends. So I'll tell you, generally speaking, safes are probably the easiest to document, the least expensive from a legal fee perspective, because you typically just have one document and it's short and there isn't a lot to negotiate and you're done. So you might spend a lot less time on that. The general range of what you might expect to spend will depend, because it depends on the size of the safe, how many safes there are. If you're going to go out and raise, let's say 10 million or 5 million in this example, but you're going out to 20 different people and they're all going to be putting in a small piece of that 5 million in a safe. So the lawyers are going to have to manage 20 different investors coming into the company. That's more work on their end than if there was just one investor that's putting in 5 million in a single safe. So you can see how the numbers can change and the amount of time and effort put into it. Generally speaking, less than 10,000, I would say, for a safe, and that's probably more than you would spend, but I'm careful because I don't want to give you a really low number and then you have a particular deal that's really complicated or something and it's going to be more than that. So that assumes fairly simple, straightforward, not a lot of negotiation. Oftentimes it can be done for less than that, but if there's some other extenuating circumstances, it can be more. Convertible notes are a little bit more than that. Because oftentimes it's a little bit more complicated. You're talking about debt, so there may be some other issues you need to look at, but also fairly straightforward. I'd probably give the same price range, again, assuming very simple, straightforward, plain vanilla terms. Your priced equity round, right? Your venture financing round. I'm going to give you some general numbers, not from the legal perspective, but what I see investors oftentimes put in their term sheets. This doesn't mean this is what it's going to be, but this is what oftentimes you'll see in a term sheet, because oftentimes the VCs that are investing, the lead in VC, whoever's going to be the lead investor, and there usually will be one, it's usually the one writing the largest check, but not always. They're leading it. They oftentimes are going to put in the term sheet that the company will pay their legal fees up to a certain amount. So if it's a Series C, Series A, relatively straightforward. I've seen those anywhere from probably low end 20 to about 50. It could be more than 50,000. The size of the raise, again, if you're doing a VC round, typically VCs are going to invest more dollars. You're not going to get a VC investment for 500,000. Typically, you're going to get a VC investment if you're looking to raise several million or more. Usually, 3, 4, 5, 6 or more million, depending on the VC. There are some micro VC funds that will invest smaller amounts, but these is just generalities. So you can expect anywhere from 20 to 50 or more thousand for the legal fees. That's For the company side, maybe more. If there's a legal opinion, oftentimes will be more. But that's oftentimes what you'll expect in the term sheet. The VC is asking for the company to pay. We have about 10 minutes, so let me ask this. What's a finder? So a finder is essentially someone that goes out and finds you investors. This is an area that is fraught with risk. There are a lot of folks that call themselves finders. They're out there doing stuff that is not legal, is not proper. You have to be really careful. Finders are really regulated, and they can only do a very, very limited scope of trying to find you an investor. And I don't want to spend too much on it, but most of the time when we're working with a startup, they're not working with a finder. We don't recommend that they work with a finder because it's really hard as a finder to stay within the boundaries of what the law allows a finder to do. And most of the time, what happens is the finder inevitably starts to do things that sort of trespasses into an area that they're not regulated to do legally. So a finder purely can make an introduction, and that is it. Hey, John, John's, I want you to meet Abe. Abe's the founder of the company. I think you guys would be a great fit. John, I know you're looking to invest. Abe, I know you're a startup looking for some money. You guys go talk. Something that simple, that's all they can do. And the compensation they get paid is also very regulated. So anyway, don't want to spend too much more time on it. Feel free to reach out to me afterwards, but you want to be very, very careful with using a finder. And if you are going to use one, make sure you get really good legal counsel to guide you on what they can and can't do. You haven't covered what happens when between raising, first round, and IPO. Okay, well, good question. So when you raise, generally speaking, as a company grows and you're doing financing rounds, you start off, as I said, family and friends, safes, convertible notes, what have you. And then you get to a point where you do your first venture capital round. Let's say it's a Series A round. Well, you get that bucket of money, that pot of money, that should tide you over. You should have a runway for the next whatever number of months you've calculated out in your budget. And you want to be careful in what you're budgeting because you want to know you've got enough now from this raise to get you to the next point where you have capital coming in. I talked a bit about that, making sure you've budgeted properly. So between the closing of your first round, there will oftentimes be multiple other rounds. So as the company grows and scales, you're going to need to do a second round, oftentimes a third round, potentially a fourth round. There's no specific number of rounds. You look at the size of the company, the market, what the growth rate is, and then you also look at when an appropriate time might be for a potential IPO if you're looking at an IPO. It's usually much further down the road when you've got enough of a base, you've got enough assets, you've brought in enough money to be able to justify doing an IPO. And then it's a sit down discussion with your lawyers about, okay, tell me about all the pros and cons. What should I be aware of? What do I need to be factoring in to think about doing an IPO? We've represented companies that have gone the route of raising early rounds all the way through, A, B, C, D, and then they get sold. We've also represented companies that have gone through that same sort of financing trajectory to the point where they go public. And it just really depends on what the company is looking to do. But oftentimes there's multiple rounds after your first round between the first round and whether you have some sort of exit like an IPO. Okay, what happens if you don't have any family or friends? Well, that's when you need to start working on getting out into the community and meeting people who can potentially be investors. You can always go out. There are great trade organizations. There are great events. There are great ways to get in front of investors. I would try to look at the best way to get introductions. I oftentimes tell clients that the best way to get in front of an investor, to get an investor's attention, is just to be referred by someone that they know and trust. And sometimes that just takes time of building, sowing the seeds of the relationships you have so that at some point they'll mature to the point where you can, have an introduction to an investor. In some cases, it can be finding the right investment company, firm, and getting to know them, not asking them for money, as I mentioned earlier, but just getting to know some of the folks there and asking them to talk to you about the industry or, what is it like to be an investor, and find a way to get them to talk about themselves and what they do. Most people like to do that. So it's easy way to get through the door and talk to someone. And then, do that enough times, you start building your contact base. Okay, we've got about 5 minutes. Let me see if I can run through some of these. In the United States, can an H-1 immigrant employee start a startup? There are mixed answers about this. Great question. We actually have an immigration practice. I work with my colleague all the time because a lot of the startups I represent have folks overseas that want to come and work here. So I will work in tandem with my colleague to make sure that we can address their immigration issues. What I would say is, please reach out to me, and I can set up an introduction to my immigration colleague, and he can answer your questions, so that if there's a path for you to come and work here in the US, then we can certainly tell you what that is. He's really good. He's been practicing a long time, helps with a lot of startup issues with regard to immigration. Okay. Do you generally get a CPA to do the company valuation? Oh, that's a great question. So there are some CPA firms that do valuations. Oftentimes, though, you will go to a valuation firm. It's a firm that specializes in doing valuations. The calculations are complicated. There are certifications for firms that do valuations. So if you go out to a firm, you want to make sure they're properly certified, have the experience. Just having a CPA designation does not give you the ability or the experience to do a valuation. What I will tell you, if you're doing, depending on the purpose of the valuation. So as I mentioned early on, when you set up an equity incentive plan, you need to set it up properly. If the company is going to be issuing options or restricted stock, especially options, you need to make sure you have a 409A valuation, because you have to price the options appropriately, fair market. That's when you need what's called a 409A valuation. It's a very specific type of valuation designed specifically to address IRS issues that are governing options and how they're priced and taxed and all that. So those type of valuations can be done. For example, Carta has a subscription service at a higher level. It's not their free tier service. It's a higher up service. You pay for it. But when you pay for that subscription, you get everything Carta offers in that subscription, and you get this valuation package. So they will do the valuation for you. And they've actually got a good reputation. A while ago, as they were scaling and growing, being a startup themselves at one point, they went out and acquired the folks from Silicon Valley Bank that used to do the Silicon Valley Bank's valuation. So very reputable team of people they brought over. This is a while ago. I assume they're still there, but anyway, they found great talent, experienced talent. They now offer that. So that oftentimes can be one of the cheapest ways to get at least a 409A valuation if you're doing an equity incentive plan. PowerPoint slides. This will be also put up into YouTube channel, so look for that as well. So you'll be able to see the slides once that's been posted. Another question, last couple of minutes here. For early stage startup raising a first round of funding, convertible note, safe, or even equity, with the help of a startup attorney in Carta, is there still a need for a CPA or accounting firm or tax firm? Great question. Well, you should have an accounting firm or CPA or a tax advisor anyway. You're going to need it for your company. Your company is going to have to file taxes. You're going to need to make sure you've set up things properly so the taxes are being paid, you're filing the right returns. But they oftentimes can help you set up your financials. They can help you with your financials, make sure you're categorizing or characterizing things properly so your financials are accurate. So yes, it is important to work with one. But with regard to raising your first financing, whether you need one or not, I guess you'll need one to make sure if you're far enough along that you've had to file taxes, then yes, you should have engaged one to help with your taxes, file your taxes, because oftentimes the investors will look at your tax filings, your financials. That's going to be an important piece of the diligence, so they will want to see that. So I always recommend get a good attorney, get a good tax advisor. Those two advisors can be tremendously helpful on an ongoing basis, even early on, especially when you're going to raise financing. Okay, I know we're running out of time. I'm going to try to run through a few more. Somebody asked me about my hourly rate. Please reach out to me separately on that. During a particular round of financing, can I issue shares based on different share prices to different people? For example, onboard investor and plan to issue shares to him at $1 share. At the same time, I had a co-founder, but would prefer issue shares at him for 1 cent. So yeah, this goes back to what I said a while ago at the very beginning, is be careful with how you're pricing the share. So Different types of shares can be priced differently. So preferred stock oftentimes has a different price point than common stock. But if you're talking about giving common stock to one person at one price and another person at another price within a relatively short period of time, that can be problematic, because what's the justification for the difference in the price? You don't want to have a situation where there's a discrepancy. You know, John got shares at a penny a share on, you know, January 1st, January 10th, Wanda got shares at 5 cents, and there was nothing that happened at the company that would have justified a change. That's going to be a problem for you. It'll be a problem, potentially tax. There could be tax issues, but more importantly, it's going to be a problem with investors looking at the company. Why are there such differences in the price points? What's going on here? It doesn't make sense to us. So you want to be careful about that. Okay, I'll take one more question, and then whoever didn't get their question asked, I'm sorry, there was quite a few. Please feel free to reach out to me afterwards. Which are the best places to find seed angel funding investors for sports tech startup? Oh, great question. Well, you know, to the extent there are some trade organizations that focus on sport techs, I would look at those. I would, you know, spend a little time researching on the internet. Look at some investors. You know, you can oftentimes see what investors are investing in, and if you find some that are investing in sport technology, then I would reach out to them and build those relationships. Again, not looking for funding directly, but sort of an indirect route. Get to know them, talk to them, build those relationships. So at some point you could ask who might be an appropriate investor in that field. Okay, we are at the 10:30 mark. I know I went through a lot of material in a relatively short period of time. Thank you so much for attending today. I really appreciate the opportunity to be here and to talk to you about what I do on an everyday basis, helping companies, especially how to help them prepare for a venture capital financing. Hopefully you found this information useful. I will send out an email with the link to the recording. You're always welcome to contact me. I have my email address and my phone number, so don't hesitate to reach out if there's something you didn't get an answer on, or if you have another question or just want to talk to me directly, feel free to reach out. We'd be happy to chat with you. But it's been my pleasure to speak to you today. I wish all of you the best of luck in your adventures as a startup, if you're working in a startup or if you're a founder. Best of luck to you, and hopefully there'll be another opportunity to chat with you. Thank you.